Okay, let's just jump right in. For decades, we've all been playing by a certain set of economic rules. But as we look ahead to 2026, it is becoming crystal clear that the game has completely changed. The old playbook, it's obsolete. A new one is being written right now, in real time. So in this explainer, we're going to break down what that new playbook looks like.
And wow, there's really no better way to kick things off than with this quote from JP Morgan. It just hits the nail on the head, doesn't it? It perfectly captures this massive sea change we're all living through. The core assumptions that shaped everything, from investment strategies to government policy for a generation, they just don't apply anymore. So, what replaced them?
First things first, we need to understand why 2026 is such a pivotal year. It's not because of some single dramatic event that's going to happen. It's more like a breaking point, a moment where all these different timelines of debt, demographics, and political pressure, they all crash into each other. Now, this slide really lays it all out, the before and the after. We've gone from a world that was pretty predictable, low inflation, stable geopolitics, to one where inflation is not just higher, but way more volatile. Globalization is taking a back seat to reindustrialization and these competing economic blocks. And maybe the most important shift here is that last one. We're moving away from independent central banks in towards something called fiscal dominance. Now, that's just a fancy way of saying a government's need to pay its bills starts to overpower the central bank's job of fighting inflation. Basically, government spending starts calling the shots for monetary policy. And this shift creates a really fundamental change in our psychology. I mean, the banks haven't collapsed, the markets haven't just disappeared. But that feeling of unconditional trust we used to have in the system, it's kind of gone. Access to your own money can start to feel conditional, with slower withdrawals, sudden rule changes, more red tape. The system is still working, but the rules of the game just don't feel as certain anymore. So that feeling of uncertainty, it's not just in our heads. It's actually rooted in a massive mechanical problem that's churning right below the surface. And that brings us to our second point. The central issue driving this entire new reality is this unprecedented wall of global debt that has to be refinanced. This is the engine under the hood of all these changes we're seeing. And when we say wall of debt, we mean it. We are talking about trillions of dollars in sovereign debt that just has to be rolled over between 2026 and 2027. The scale of this is honestly hard to wrap your head around. It's basically the hangover from an entire era of cheap money. So the key thing to understand here is something called refinancing risk. This isn't about governments going on some new spending spree. No, this is about replacing old loans that were borrowed at practically 0% interest with new loans at today's much, much higher rates. All of a sudden, interest payments go from being some minor line item in a budget to a massive, dominant government expense. And this is exactly where a spreadsheet problem turns into a massive political crisis. I mean, when the money you're spending just on interest starts to rival what you spend on national defense, or it starts to crowd out funding for healthcare and infrastructure, governments get backed into a really tight corner. And all the choices are politically toxic. You can raise taxes on people, you can cut popular programs, or you can quietly try to inflate away the value of the debt. And that last option leads to what economists call financial repression. It's probably the most likely path governments will take because it's so subtle. It's a strategy where you basically let inflation run a little bit hotter than the interest rates you're paying on your bonds. This allows your economy's growth in dollar terms to outpace the real cost of your debt, and it slowly, quietly reduces the debt burden over time without a big, messy crisis. Now, the consequences of this big debt squeeze, they don't just stay in government circles. They ripple outward, and they create a much more fractured and uncertain world for everyone. This isn't just a government problem, it changes the entire economic regime we all operate in. And we can see this fragmentation playing out right now in the global monetary system. It's like two separate tracks are being laid. On one side, you have the BRICS bloc, and they're moving more towards gold as a neutral asset for settling trades. On the other side, you have the Western bloc, which is pushing forward with digital settlement and things like sovereign-backed stablecoins. The world is literally splitting into two parallel financial systems. So for you, for me, for individuals, this new world introduces new kinds of risk. It's not just about worrying about inflation or market crashes anymore. Now you have to think about things like access risk. Can you actually get your money when you need it? Policy risk. Could the rules just change on you overnight? Custodial risk. Is the institution holding your money really as safe as you think? And settlement risk. The question is no longer just, what is my money worth? But can I actually use it when I need it? So with all these new challenges, the big question is, how do we adapt? What do we do?
This brings us to the new playbook for everyone from big investors and institutions all the way down to individual savers. This quote from the Economic Times is, well, it's pretty stark. The traditional safe asset, the thing your grandparents told you to buy, the long-term government bond, is being completely reevaluated. If governments are indeed using financial repression, then these bonds risk becoming tools to devalue your savings, not protect them. And as a result, you see the big money, the huge institutions, they're already pivoting. They're moving toward what are called real assets. We're talking about things that can actually benefit from inflation, currency debasement, and all this reindustrialization. This means industrial commodities, precious metals like gold and silver, and even very specific stocks that can do well in this kind of environment. Now, for us, for individual savers, the strategy here isn't about abandoning the traditional system. That's not realistic. The new goal, the key word is redundancy. It's all about building layered alternatives so that you're not totally dependent on a single point of failure. And here's a really practical model for what that redundancy can look like. Think of it as 4 buckets. Bucket 1 is your traditional bank. That's your stability layer for day-to-day stuff. Bucket 2, you have regulated platforms that act as a conversion layer, an on and off ramp between systems. Bucket 3 could be holding some savings in stablecoins. That's your mobility layer, the ability to move value 24/7. And finally, maybe a small portion in bucket 4, self-custody, which gives you ultimate control. And I want to pause on this for a second because it is so critical to understand the role of something like stablecoins here. They are not a speculative investment to try and get rich. They are infrastructure. Think of them as a tool for mobility, designed to park capital and bridge different financial systems with as little friction as possible. So as we start to wrap this up, the future is really being defined by a massive conflict between two powerful opposing forces. It's a story of incredible promise colliding with intense pressure. On one hand, you have the unbelievable promise of technologies like AI, which could seriously unleash a new wave of productivity and growth. But on the other hand, you have the immense pressure of a global system that's strained by debt, inflation, and all this fragmentation. These two megatrends are literally pulling the world in opposite directions. And the promise side of this equation is not just hype. The data is already showing that AI is a massive economic force. Large tech companies now account for nearly a quarter of all U.S. market capital expenditure. And get this, in 2025, AI-related investment actually contributed more to U.S. GDP growth than consumer spending did. I mean, that is just a stunning economic shift. Which leaves us with one final and I think crucial question. In this new world of promise and pressure where access to our own savings can sometimes feel conditional, we have to rethink our most basic assumptions. So what does financial safety truly mean to you in 2026 and beyond?